period for both gold and silver. What are the exact ranges? I don't know. And they'll vary. It's not like a perfect channel formation between 2,200 and 2,400 for the next 3 or 4 months, but something like that for gold. And silver, obviously, it's gotten below 30 now, so maybe 29 to 31 in that range. Will it go below 25? I can't say it wouldn't. I doubt it, but it could. But basically, we're doing a trading range. How big or how wide is that trading range? I'm not sure. How long will it take? I don't know. But my guess is for gold, couple $300. For silver, $3-4 probably. And I think it'll just go into the late summer. So September, October, I think we'll start to see the metals, regain traction, and the war drum's beating ever louder as we speak. There's a possibility that gold could go up limit 3 days in a row to basis what's going on between this escalation and talking nuclear more and more frequently. So,
in today's market recap, big silver rally of 2024 stalled. Why and for how long? The big silver rally stalled because speculators were unanimously long. The market does not reward consensus trades. The silver market will require less speculators before moving higher. Silver experienced a solid bull run in the period March to May 2024. Right before hitting silver's first bullish target of 34.70, the big silver rally 2024 stalled. Why? And for how long? Just to be clear, silver will hit $50 sooner or later. The question is when exactly. It's a matter of when, not if. Silver experienced an excessive number of speculators betting on the long side in the silver futures market. This, as said in our premium silver alerts since April, would prevent silver from moving much higher in the short to medium term. Speculators finally are giving up. Finally, they have been hit undoubtedly during those days with larger red candles. Remember, this is a futures market indicator. The leverage is insane when holding futures, so a 5% one-day decline has tremendous effects on a portfolio holding silver long futures. It's too early to get excited, but speculators leaving the arena is the prerequisite for silver to move higher. Lovely development, likely just the beginning. There will be a point in a few months where speculators will be hating silver, which is when we'll love it. Now we'll show you the best clips, but first, smash the subscribe button and turn on notifications. Enjoy the episode.
Well, let's start off the Commitment of Traders report. I'm pretty good at reading it. No one's got it exact, but you can see the trends are pretty obvious if you studied it for very long and a half of years. I just took a look at it. The open interest really hasn't dropped that much on the last report. So, and the way it was stacked up just a few weeks ago, it was indicating that the metals had reached a peak and we're on the decline. I mean, my friend Chen Lin is very smart and very good. He saw room for it to expand, for open interest to increase, and he was right. It had the potential to do that. But the way I saw it was seeing the same thing and seeing it differently. I thought we were close enough to what we considered to be the max participation for longs and shorts. And basically, when you get to that high level, that's about all she wrote. And you're going to see a correction in the metals. And the game is going to go down to a certain level in the open interest. And once it achieves that, we'll start back up. And it's not a perfect timing mechanism. It's more like a barometer. It gives you a very good signal of what's ahead. You just don't know if it's a day, a week, or a month ahead, or 2 months. But it's, okay, we're pretty much topped here. So that doesn't surprise me. As far as the fundamentals go, it's a very interesting market because the fundamentals, as you well know, and your viewers know, we are at a point where fundamentals continue to get better and better, not only from the reasons to own gold, as we just outlined, but the fact that the central banks are leading the way and indicating that the smart money or smartest money is and has been moving into gold in a very deliberate manner. On top of that, if you look at the silver side of the equation, retail's pretty much been left out of this move. A lot of retail said, okay, I got $30 silver or $31 silver. I paid a very high premium months ago with silver's at 25, and seemed like the retail market was extremely tight and premium shot up and paid $30 for a $25 silver. Well, now you can go and cash out at, break even or maybe a slight profit. Maybe you bought too much. Maybe you don't believe the story. Maybe you just want to rebalance your portfolio. Who knows? But the facts are that the wholesale market is getting more sellbacks than buys from 3 or 4 that I'm very familiar with and can call and get direct information. But that doesn't mean that the market isn't fundamentally more bullish. And this is what we're seeing on the industrial side and the investment side outside of India and China. I mean, China has caught the silver bug, and their investment community is certainly participating in this rally, as well as the industrial commodity for use primarily in solar panels. And the same thing holds for India. So it's a very interesting market at this time, but the strength is still there. I'm not taking back what I said. We're going to consolidate. We're going to be in a trading range, but the fundamentals continue to improve.
In the continuation of the episode, we explore the enduring roles of gold and silver in the investment landscape. As traditional havens, these metals serve as crucial assets, particularly in times of economic turbulence. Gold has shown resilience, fluctuating within a predictable range despite global economic uncertainties. Silver, having briefly crossed the $30 threshold, demonstrates its appeal to investors. These trends are typical of bull markets, testing the resolve of long-term stakeholders. Geopolitical tensions have a pronounced effect on precious metals. As conflicts escalate, the demand for gold increases, driving up prices. Silver follows suit, though its industrial applications also influence its market dynamics, adding a layer of complexity to its investment profile. For those looking to hedge against inflation and currency risks, gold and silver present viable options. Experts recommend a dollar-cost averaging strategy to manage price volatility. Despite potential short-term fluctuations, the fundamental appeal of gold and silver as protective and potentially lucrative investments remains robust. Now we'll show you the best clips of the latest interview, like subscribe and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
What I would say is you're falling into a typical bull market. And the bull market, as we've discussed before, shakes off as many longs as they can. And this is one of those shake-off points. People that have, maybe they bought it at 18, maybe they bought it at 20, a 10% gain on that investment, that's 30-40%. And again, a lot of people, and what I've seen, and of course I've been around a long time, but it's just my own personal experience. Once they learn the truth about how the monetary system works and what a scam it really is, where a few get to dictate the money power over the many, I've seen it many times where they kind of overdo it. They get it, they understand it, they verify it, they've educated themselves, and it is the truth. And it is a very unfortunate situation. And I'm gonna make it right for what I can control. That's me and my personal finances. So, all my available cash, I'm moving into gold, whatever. And that's an extreme example, but a lot of people do go overboard. And when I put out the 10 rules of silver investing, which could apply to gold investing, apply to other investments actually in some cases, but the idea is to take a long-term view, dollar cost average. And then I said in that rules, I forget which rule it is, but something like too much of a good thing is too much of a good thing. In other words, I was recommending a certain percentage and not to go overboard, because you don't need to go overboard to have a hedge, a balance, and almost a certainty that you have prepared yourself financially for probably a worst case scenario. And that was my, principled approach to try and help everyone that was a new or a seasoned investor in the precious metals, because, like the amount of nutrients or vitamins or whatever, there's kind of the precise amount, so many milligrams on a certain medicine, perhaps. So I'm just giving the idea that you don't need to do too much. But I find over and over that that's the case. And that's why these people feel a lot of pressure when the market moves against them they can hardly wait to break even and sell out. And rather than sell out and get to a portion that's an amount that they're comfortable with, they will sell out the whole thing and forget about it. Then the market moves up $10 against them, or they would have made a double their money from 20 to 40, for example. Now they get back in and they left all that on the table. So long-winded answer, but I've seen it over and over. And having that experience, I would say, look, if you have too much, sell down to where you're comfortable. Please don't sell out. You know why you bought it. If the reason you bought it has changed, well, then go ahead and sell. If you bought it to, get a gain so you could pay off a debt or something, and that changed or that occurred and it happened and you did it, and that's the reason you bought it, okay, fine. But if you bought it for the reason most of us do, and that is to hedge the inevitable, you don't have any reason selling at all. That's for sure.
What do you think of today's episode? Do you think he's spot on? Post in the comments section down below your honest opinion. Share your price prediction for gold and silver in 2024 and watch this video right here because it's a perfect fit for you. I see you on the other side.